on this Sunday evening when you are about to get ready for office, taking some time to um, understand some of the strategies and also understand some of the risks that are there in trading options and some of the myths that are there, which we could alleviate a little bit in this session. So to start with, I'm not sure how many of you already know in-depth options or at least trade options. So I have a couple of slides here which just provides quick basics before we jump into some low risk strategies and discussions. Okay. So let's get quickly started. What are options, right? So for stocks, when you see something like a stock, there are two simple things that you can do. You can buy a stock or sell a stock. Okay, that's as simple as it gets, and a lot of technical analysis can be done on stocks, where to buy and where to sell, right? But with options, what they mean is options are kind of a derivative on top of stocks. What it means is there are a lot of option contracts that can be traded on a specific stock. For example, when we go and look at, say, Amazon, we can see that there are a lot of expirations that are there for options. And when we go, you can select any expiration for that matter. It's like when you buy a house, you agree to buy a house, say on January 1st, 2022, or maybe November 1st, 2021. So it's just an agreement for on the top of the house, and then you have a date on which that agreement comes into effect, right? So these are options or nothing but you are agreeing to buy these stocks at certain price. Okay. In the same way, when we go open, say, September 17th expiration, right? Here it you will see a lot of details here for Amazon. So what is happening here is at a very high level, there are put agreements that are traded and there are call agreements. So call agreements are typically like people buy them when they are thinking that the stock price is going to go higher. And put agreements are typically people buy them as an insurance. For example, you have a car of say $50,000 and you want to buy insurance coverage for that car, and the insurance coverage value is for $50,000 and you pay premium, correct? So if something happens to the car, the insurance agent takes the car in whatever form that is, like total car or something like that, but he gives you the money back. Okay. So this is kind of puts or kind of insurance. So while the stock price is at 33.50, around this price, right? But these option agreements can be traded for any strike that is below that, or a lot of strikes above that also. So that adds to the complexity. Now you have to choose expiration, and then you have to choose which strike for that expiration that you have to buy, right? So added complexity. And after that, once you identify the strike, the expiration, then you have a bid and ask for that. So this comes to the point where it was as simple as buying and selling a stock for certain value. This bid and ask price is buying an agreement of certain expiration of certain strike price, whether it could be leverage type, upside leverage type call, or it could be put. Okay, so let's say 3,600 call. Let's take this one for example, or 3,500 call for that matter. So when we go and select that one, this is a unique combination. Okay, so and when you see this code that you see, Amazon, so this is the stock symbol for this specific agreement out of thousands of agreements that are there trading for Amazon. So this is a unique code for the Amazon stock. So that's what I would like to kind of, I wanted to quickly show you what exactly it is. When you copy that code, what is happening here is the dot represents, it's an option, and it's the ticker symbol. And then there is a date in here, which is year, month, date. And then there is a call or a put. and the strike price. Okay, so this is a unique agreement. So now that being said, let's quickly compare what typically people, what are the different types of options, right? So when do you go and buy a call? So you go and buy a call when you think the stock is moving higher, okay? And for buying a call, you pay premium. That premium is the price that you see here. And if it is $11.80, what it means is each option contract represents 100 underlying stocks, like you see 100 here. So it means that you have to pay 11.8 times 100. If you take approximately $12, $1,200 is something that you have to pay to buy that option. Okay. So even though it says $12, when you kind of confirm and send it, you have to pay $1,200. Okay, with plus commission. And also we have to think from the perspective of when we are buying these calls, who is selling it to us, correct? And why is he selling it to us at certain price? So that is important to understand. So the seller of a call, from his perspective, thinks that the stock stays below that price. So if you are going and buying 3,500 Amazon call, you think that the stock is going from here towards that price or even higher, right? So that's why you're paying this advance and then trying to kind of buy it. But the person who is selling, on the other hand, thinks that the stock might not go more than 3,500, and he is collecting a premium of 1,200 from you. So this is a very important thing that you would like to understand, because as a buyer, when you buy something like at this price, if the stock goes above 3,500, you start making profit. But what is happening, or for a seller, you pay premium, he collects premium. Okay. And as you get profits above 3,500, he starts getting losses um, above 3,500. Okay. And what happens when you buy a call? Only way to make money is the stock moves higher. It's just not sufficient that the stock moves higher, but it has to move very, very fast higher. Because what happens is if it moves slowly, then even as the stock moves higher, you still will get a loss if it stays below 3,500 by expiration. Okay. On the and how would you lose money when you buy a call? If the stock moves sideways, or the stock starts falling, you start losing money. Why? Because time decay is against you. The option value, for example, when we go and look at it, we are paying 1,200, correct? $1,200, and say Amazon slowly moves by September 15 to 3,500. Okay, so what it means is this option gives you a right to buy 100 Amazon stocks at 3,500 price, correct? So, and this option, as of now, they're asking a advance payment or agreement of $1,200, which means if it goes to 3,600 or say $4,000, you pay $12 and you can make close to $500 profit on each contract, right? So that's what it means. But the problem is, if it still goes $50 higher and goes and settles exactly at 3,500 price, which means this agreement lets you buy 100 stocks at 3,500, and in the open market also you can buy at 3,500. So there is no one would be interested in buying this agreement, even if you want to charge say only $1 or something like that. So this $12 that you're paying can completely become zero in the next 19 days, even if the stock moves to 3,500. So that is the problem. This $12 keeps on decaying every day, um, if, as long as it stays below 3,500. So that's at a outshell. So you keep losing money if there is a sideways action. And even if the stock starts falling, you keep losing money because time decay is working against you, and volatility reversal is also against you. So we'll discuss that a little bit into that. So, but on the contrary, when you start selling a call, You lose money if the call goes above that strike price, but you get to keep money even when the site goes sideways and stock starts falling. Okay, so that's about a long call. And how about put? Okay, the put, on the contrary, you are buying it. Why you are buying a put? As an insurance, you think that the stock moves lower and you pay premium, and the only way to make money is stock moves lower faster. Okay, and there are two ways to lose money. Stock goes sideways and stock moves higher against your bet, right? It goes lower. So the same thing applies, but as a seller of a put, why do you sell a put? You think that the stock stays above that strike price. Okay, and there is one way to lose money if the stock actually goes below that price, and there are two ways to make money. Okay, so buyer of a put thinks that the stock goes lower, seller of a put thinks that the stock stays above certain price and collects premium. Okay, but he has more ways of making money. That at a very high level, but we'll discuss. We'll do a deep dive soon. And so why are they charging me $1,200, right? What is there in this contract that I have to pay $1,200? Okay, but if I go and look at say booking, it's a 2,300, and when you go and look at some call, why are they charging say why are they're charging $45, right? So what exactly the option premium that you're paying for is very important to understand. Okay, so it has a intrinsic value and an extrinsic value. Intrinsic value is something, especially when you go and buy some strikes. Say, let's go back to the Amazon. So the current market value is 3,350, but you want to go and buy a 3,000 call, which is there. So by buying this call, you have a buy right to buy stock at 3,000, right? But in the open market, it's selling at 3,350, which means if you use this contract and buy at 3,000, you can immediately sell it in the open market itself for 3,350, right? 100 stocks. So there is a value of $350 intrinsic already in it. Okay, so that is why there will be the price is $350 plus some $3 extra. Okay, so that is the intrinsic value that we are talking about. The intrinsic is very good, and you don't need to worry about it because the option already has that much value. You can use that option and get that much of it on the strike price. Okay, and there is the extrinsic of $3. Okay, there that we saw like 350 plus $3, right? What is that extrinsic value? That's our enemy. We went in the money and we kind of saw that it's pretty good. I have all the money, only $3 like I'm paying extra. But when you go at the money like 3,400 call, say, you're paying close to $3,200. Why are you paying that? And what happens? Is there any intrinsic value for that one? There is no intrinsic value because this agreement lets you buy the stock at 3,400, but in the open market it is 3,350. So no, this agreement has no intrinsic value, and whatever that you're paying, you can lose that completely. So while there was $3 intrinsic value, extrinsic value in the 3,000 contract, there is 3,200 extrinsic value, which means you can lose all this 3,200 if the stock kind of stays here sideways or goes sideways, right? So that is very, very important thing to understand. A lot of people who start trading options, they learn by how to buy calls, how to buy puts, and they don't know why they are paying that much price and what is that they will be losing if the stock goes sideways. Okay, and that is the problem. So they are paying like quickly like $3,200, and then they do that's completely extrinsic. See, there is an intrinsic value of zero, and they can lose all that money if the stock goes sideways or even goes lower. Correct? So that's the problem. And why they are charging, if there is no value, intrinsic value, why they are charging you 3,200, right? So that's where you need to deep dive into extrinsic value and what exactly it constitutes, right? So it mainly constitutes implied volatility and time decay. I mean, if you might have heard those a little bit, but that is very important. Two important things actually. There is it's in red for a reason because it's our enemy, and every day passing by, both of these are working against you. Okay, so let's take a quick look at implied volatility. So what it means is, say for September expiration, you are looking at a $129 move, a 20% implied volatility. That's because it is Amazon. Okay, 20% upside or downside. Okay, how do they get that? If you go and take the price of call around $50 and price of put around $53. So when you add them together, that's approximately the price that you are getting here. So if you buy options and the total value that they're charging for a call and put is an implied move. They're saying the stock could move close to $130 higher to 34.70 or $130 lower to 31.20, like that. So there's a range defined, right? And not all stocks moves at the same pace, right? For example, if you go and look at AMC, why it's not 20%, right? Why it is 172%, right? Because this is kind of, a stock that has moved tons, right? So AMC, when we go and look at it, it has moved crazy. Okay, that's why, the options are pricing a lot of volatility move. If you go to GME, it's 160%. So not stocks have the same implied volatility. If you want to buy a fast moving momentum stock, the option premiums are more because option trader would like to make money, but at the same time also they have to manage their risk, right? When they are selling options, stock goes higher, they have to pay you profit. So that's why the option prices are hyped up for that. Okay, so that is the IV component of it, and it's not same for all the stocks. It varies, and you have to really understand that. Okay, and there is time decay also. Time decay, what it means, given the probability of say 20 days, the stock could move plus or minus $60. But if you give 140 days, the stock could move $164. Okay, so that's why when you go to long-term expirations, they will charge more premium, and that's why they are very expensive because there is a lot of time the stock could move a big moves in that. Okay, so with that understanding, let's go and quickly see this first enemy, right? Implied volatility and when it will increase. Okay. So if things are going normal, like the stock market, typically it goes higher, it keeps on chugging along well. So nothing unusual is happening. Everything is expected. So when nothing when when it's going slowly higher, the implied volatility slowly falls down because it's the usual thing that happens. But when it starts falling, everybody is thinking it's going higher and suddenly it starts falling. Then you see the implied volatility kind of jacked up quite a bit. Okay, so that is one possibility. The other possibility is whenever there are earnings. So for example, here there is earnings. So if you think that without earnings, the stock moves say $10, but if there is an event, the stock could move $30, $40, right? So the options have to be adjusted or they have to be hyped up to include that much implied move plus or minus $30, right? So that's why the volatility IV increases into the events. And it's not clearly visible outside, and a lot of people do not know this concept, but that's where a lot of people lose money. Okay. So, but you have to be careful of when the IV is high, and then whether you are paying when the IV is very high, the option premiums are very, very elevated. How much elevated? So let's go on to do a quick example. Say, when we go and look at Baba. Okay, what happened to Baba recently? it fell quite a bit, right? So what is happening to the volatility? Okay, the volatility on August 12th. On August 12th, it was at 40%. Now, because of this big down move, there is fear, right? Everybody was thinking, nothing is going to happen here, but it broke and moved quickly. From 40%, it moved all the way to 80%, which means the volatility doubled, 40%. So there is a option geek called Vega. And when you go and look at that Vega here, which represents volatility, so that Vega is 14 cents. What it means is every percentage move in volatility, the option value changes by 14 cents. Okay. Now we can do a quick calculation there. So we know Vega for this one is 14 cents, so 0.14, and the volatility jacked up by 40%, right? For each person, 0.14, and then for 40%, you're talking about $5.6. So what it means is in this, if you go and buy this one, 7.25, out of that premium that you're paying, $5 is volatility, and only 2.25 is the actual value. So the prices were so hyped up and jacked up, right? So when you go and buy a call here, what happens is, you're paying $5 more than the actual value. Okay, and what happens? A lot of people go and buy calls here, saying that it's going to go bounce, right? But they do not see any profits even when it goes higher, because the next day when it goes higher, it fell from 80% to 60%, which means 20% it fell down. Okay, so in other words, you did not buy on the right moment, and the actual value was 2.5, and you paid $5 hyped up value, right? You paid that much, and now the problem is, as soon as the volatility comes back, okay, so 2.5 actual value, and out of 40% gain, hype $5 hype, right? It fell down 20% back, so suddenly that $5 will become 2.25. 2.5. So what it means is, if you paid $7.5 here, the option will be worth only $5. Nothing changed, right? The stock moved higher. But because behind the scenes the volatility is falling dramatically, uh, you will be seeing that the 7.5 suddenly becoming $5, and you don't understand why. Okay, that is why a lot of people think that the options are risky, because they do not know what exactly the premium that they're paying, and is it hyped up or not, and why exactly it is coming down even when the stock is moving higher. Okay, so I think that should be the basics that we should be focusing on, right? And that's what I meant. So two reasons, right? Earnings, and then when the stocks fall, suddenly the IV increases. Whenever the IV increases, for each percentage change, there is a vega, and the option value fluctuates by that one, and it's hidden, and it's very dangerous. Okay. When does IV falls? IV fall immediately after earnings, because the event is over. There is no potential big news coming, and then there is, things go normally, right? So it immediately falls back. For example, let's go and look at some of the earnings that happened. Snowflake, it's not a good. See, into the event, it was at 52%, but as soon as the earnings is done, 25%, half volatility is down, right? So if you paid $5 IV there, it will be 2.5. Okay, and even if you take it did not finish yet. So you see there was like Palo Alto Networks, the volatility was at 45%, and now it is back immediately at 29%. So you'll be losing that money, Vegas, if you go and buy a call. Even the stock moved higher, luckily, but if it goes sideways, then you'll be losing that. Okay, so you need to understand those things, events and stuff. Okay, and this is time decay, right? Time decay will be higher, and then there is gamma and vega. So how the option prices changes with respect to stock, right? So delta says how much the option price will move for each dollar underlying, and then gamma says how much delta moves. This is, I'm just going quickly, but and then as each day passes by, theta says how much value the option value decreases, and whenever the volatility changes, how much the percentage change, right? So you need to understand these in depth so that you can make a decision. So now that you know all these things, you could play bullish or you could play bearish, but you have to understand the other perspective. Are the option premiums hyped up, or are they kind of very, very lowly priced, very, very fairly priced, right? So you need to understand that. Okay, so that dictates which strategy you should focus on. You can be a buyer or you can be a seller with options. Okay. So for example, if you think that the stock is going to go bounce higher, say Baba, right? And you want to go play to the upside, right? So you have two options. You can go and buy a 200 call, or which thinks that, okay, so I'm going and buying a 200 call. I'm going and buying a 200 call, all good, right? But depending on the time when you are doing it, you might be paying a lot of hyped up premium, right? If you did exactly here, or you can say, I will go and say sell a 150 put. Okay, you can go and sell a put. As we discussed before, you buy a put when you think the stock is going higher, right? But if you sell a put even think that the stock is going to stay above that price. Okay, so two different strategies you can do. Play to the upside, right? And out of those two, how would you determine which strategy to use? That is the question, and which is more probability, right? So say for example, I'm putting a level at 50%. So if you come and look at the IV, and then if you see that it is above 50%, which means option prices are hyped up, so then there is more probability for you in making money by selling a put. Okay, why? Why selling a put is good in this context? Because the premiums are so hyped up that by selling, you can collect almost like $7.50 for this option. Okay, and as the stock bounces, it loses value immediately, and you collected $7.50 premium, and it immediately becomes $5 just in a matter of couple of days, right? So that is the right strategy than buying a call. Okay, and what are the other advantages of it? Okay, so when I go and take a screenshot of this, I will figuratively represent what is happening there. If you go and buy a call, you make money if it goes higher above that level, okay, by whatever expiration, right? So this is the only way that you make money. But what happens if it goes slowly higher there, but still there? So this is not going to work. Every day passing by, if you pay like, $7, it slowly decays and it becomes zero because it did not go above that, and it stayed below that. But even if it's going higher, you are losing money on that call purchase, because first thing you paid hyper premium, second thing is you're losing time decay, everything. Okay, And what happens if it does this kind of drama, right? So it goes higher and then you are very, very happy, and then it comes lower and do all this kind of sideways action, right? So yeah, so you only in this case you make money. In this case you lose money. Okay, that is if you buy a call. But when you sell a put, what happens is this gets you money, right? And even this gets you money, even this gets you money, and even this gets you money, because all you are asking is, I'm selling this put saying that the stock stays above 150 by that expiration. Okay, so that is a very, very high probability setup. Okay, so that's what the main focus of these things. And the reason why I had to tell all this IV thing is why selling a put makes sense than buying a call, because the volatility is very high, and it's hyped up. You can collect more premium. If you buy a call, you're paying more premium, and which loses its value very quickly, right? So that's the difference of it. Okay, so next thing is how do you know when to sell a put, right? So let's go and look at some of the stocks, say Snowflake for that matter. Okay, what happened in Snow is there was this sudden down move that happened. Okay, so when this happened, what happened to the IV? I had to add that because Snow is not 1 year old, and for calculating this study, it needs 1 year of data. So when that pullback happened, the IV jacked up from 52% to close to 10% higher, right? So and as you see, that came to a very, very long-term support. Okay, very, which is like 100 days average. And when you go and look at these stocks, what is happening here is as soon as it's coming to this 200 days average, dip gets bought, right? As soon as here multiple times it's trying to hold above that. But as soon as it loses that, the next stop would be the next average. For example, when you go and look at Amazon, what is happening here? First, it did the dip, right? It did the dip, and it was kind of trying to hold around this average price, which is 100 days average. Okay, and what is the next step for it if it loses the 100 days average, right? The next step is 200 days average. This is on a daily, but when you go and look at weekly, it will be very clear for you. Like as soon as it lost the 20 period week average, it came back and took the support of the 50 period average. Here also, as soon as it starts falling, 50 period is average. Here 50 period. So 50 weeks average, which means ultimately you're talking about 1 year average. And whenever it comes to that level, that is a strong support. And because when you want to sell a put, you don't want it to go below that one. So that is the first thing, right? So selling a put of that long-term moving average, make sure even if the stock goes down like this in 1 week, the next week it comes back. So that is the best thing that you could do, which had a very, very high probability of success. Okay, so that is very key. Okay, and also like how to choose the strike. Like the first question that people ask is like when we go and look at it, um, what option strike should I select for an option, right? So that option strike selection involves these decisions, whereas you know where the support is, and you go and sell that option option put and collect a lot of premium, especially after a big pullback like this where the IV is very, very high. Okay, so that is the first thing. Sometimes I hear the stories of, okay, so I want to buy this stock, like say Boeing. People keep asking me when is a good time to buy the stock. Okay, and they buy the stock and the stock goes down. So if you are into that option, the best way to kind of buy a stock is selling a put. What happens, for example, we go to the weekly Boeing. It's in a long-term support, right? Support here, and it's at 50 days, 50 period average, right? So, and you are not sure whether it will stay at 215 or it goes 200 or it goes to 125, but you are interested in buying the stock, right? So what you could do is find a level where you are comfortable buying the stock. Here, 50 period average was a level which is around 215. That's where you are comfortable buying the stock. So you can go there and say, you can go there and say to October expiration, which is 47 days. And then you go and see the 215 put that you see. So you say that because you're bullish, right? Because you were interested in buying a stock and you want to get in, but you're not sure whether to buy right now or not. So in that case, what you could do is you can go and then sell this put, which gives you $7.50 credit. Okay. So what happens? So sell BA October 215 put and collect $7.15, which means $700, right? So what happens by selling this put? You're saying that by October expiration, you expect the stock to stay above 215. Okay, couple of scenarios, right? The stock stays above 215. First thing is bull case, right? Stays above 215. What happens to this put when it says above 215? This puts value, there is nothing, because the stock is about 215, it goes to zero. So you get to keep all this $700 in your pocket. Okay, and then sideways, the stock doesn't go and the stock is just around 215. Okay, so then also you get to keep all the premium. And what happens if it goes to say below 215? That is the problem, right? When you sell a put, that's the problem, because you are saying that the stock stays above, but it's going below. And it completely depends on how much below it goes. For example, if it becomes at 210, what this put says is you have to, because you sold a put, you kind of sold the insurance, you have to buy the stock at that price. So you buy the stock at around 215 price. Okay. So on the expiration date, you come and buy 215 times 100, 21,500 stocks. Okay, worth of stock. That's the maximum worst case scenario that can happen. So you buy at 215, which is what you were comfortable with, and you also got 715 credit, right? So because the market price is at 210, by buying at 215, you are immediately kind of and you want to you buy at 215 and you want to sell it in the market, you can only get 210, right? So there is a $500 loss that you get per stock, but this already paid you $700. So you are actually getting it at cheaper. So the strike price that you sold was 215 and minus 7.5, and your break-in point is 207.5. So even though you are buying at 215 for this contract, you are assigned at 215, but because you already collected $7.05, your net cost of it is only 207.5. This is the best strategy for you to go and when you're comfortable buying a stock at 215, sell that And if it doesn't go below, you're making money. If it goes sideways, you're making money. And if it actually goes below that, you're actually getting the stock at a lower value than that one. Okay. So that is the main thing. And the probability of these is, as I mentioned, there are 3 different ways you can make, and there are 4 different ways you can make money. Goes far higher, faster, moves slower, fast, higher, slower, and then sideways, and even on a pullback also, you are making money. So that's the kind of a strategy that we wanted to discuss in this session. And when you go and look at it, it needs 22 27,000 20,700 margin. That's what we with 207.5, right, times 100. I know small accounts might be there. They might not be able to kind of maintain this much margin, because if it breaches, you must buy the 215, right? That's why the broker keeps this much money away, so that he can buy 100 stocks. Okay. When you are in that zone where with a small account, what you could do is you can reduce the margin requirement by selling 215, which is your bread and butter, but actually you can go and buy, say, 200. Okay, this you're making it as a spread. What this gives you is, when you sell it, you have an obligation to buy at 215, but because you are buying a 200 put, now you have a right to sell at 200. So your broker has to buy at 215, but he can sell at 200 immediately. So the only difference between those is $15, right? So that's what for this spread, you just need that 1500 margin. And because you're already collecting $4, you just need that 1100 margin requirement. Okay, that's because we made it $15. But if you can make it, if you can go buy 210 put, only $5 widespread, you collect 1.65, and the margin requirement is only $335. Okay, so that's how you can still sell naked puts, or sell put spreads, and stay consistent, and make the probability of it staying above is very high. Okay, so some examples of trades that we have done is, say, on August 16th. This is a premium group where options get traded and the trade alerts get posted on on August 16th, when Tesla had that AI event, correct? So we were able to sell 650 put and 600 put, okay, and collect $11.05. Okay, so what happened to Tesla from $650? August 16th. So let me go quickly adjust this time frame, this chart, to uh, August 16th. So what is happening on August 16th? On August 16th, there was a big down move, or around August 16th, there was a big down move. So, and we also see that, there is a upward channel in place. And if it really pulls back to that level of around 650, it's a good buy zone, right? There is the uptrend line and also channel support and stuff. And also this downtrend line also supports here. So looking at all those things, the best strategy at the time, because of the down move, the IV was high, is to sell a 650 put. But I need, close to 6,500 margin requirement, right? Yeah, 65 margin requirement. So because I don't have that much margin, so the best way for me is to convert it into a put spread. So I sell 650 and I buy 600. And what happened after that? Okay, so this is the time, right? So when we go and look at it, after that, after August 16th here, the stock slowly started moving higher. But if you have bought calls of, say, 700 calls, still you could not make money, even though it moved all the way to $30 upward, because it's moving slowly, right? So you lost all the premium paid, but by selling this put spread, you already collected $1,100, and you made a lot of profit out of it because it would have decayed, and the current value, if you go and look at it, for that September 17th would be, let me quickly look at it. So 650 is 7.8 $8, and 600 is thing. So you, because you sold, you have to buy back 3.73, which means you were able to easily generate close to $800 profit from August 16th just by selling a put spread. There might be a lot of people who bought calls, and because of this sideways consolidation, or here, for example, sideways consolidation, they might have lost $800. But this is a better way of trading it. Okay. So the next example is snow. Also, one of the examples where when it kind of did that deep dive here, no one knows why that happened, and it could have gone to 200, right? But because, you know, when you go and look at some of the long-term supports that are there for snow, and you see that 230 has a very strong support there. Okay, so if it comes there because of this high volume, it might stay above it. So at that time, if you want to trade in a hurry rather than going and buying calls, the best thing for at the time was to kind of go and sell at 230, which is a major support. The chance of the stock going down is very, very less for 5.4 credit. Okay, 200 by 200 for 5.4 credit, and this is in profit, right? So the next example I would like to say is Amazon. This is on July 7th, right? So around this price, right? July thing. So when it does this deep down move, right? So, and if you want to kind of play a sideways action, then selling this put spread like 3150 and 3100 put spread will be very good, because after selling it here, it moved down, it did a lot of drama, and then but now it's back up again. So selling a put spread and selling a call spread also makes it like an iron condor, which is an advanced strategy, but you are playing for sideways action. Why it is important? Because the stocks do not always move higher all the time. Okay, what happened to Tesla? It moved higher and it's consolidating for multiple weeks, right? So you, like from January, it's just going sideways action. If you know only how to buy calls, how to buy puts, you're not going to make money, right? Netflix. From July of last year, it's going sideways. This is a good time to buy calls. And if you enter the market in March and you made a lot of money, you might have lost more by buying calls. You might have lost most of that money by buying calls here, here, here. Okay, you need to understand when the distribution is happening, and understands these strategies of selling put spreads, and consistently generate income, or have the ability to buy stocks at a lower price than the strike price that you sold. Okay, I think that was the main goal of these things. We just focus this one, this training session to sell about selling puts, which is an alternative to buy stock at lower price, and also has more probability of generating money. So that's what the main intent was. But beyond that, the main intent is to make you understand that just not buying options, like buying calls and puts, how do you make money and reduce the risk uh, is by understanding options in depth, and primarily the option spread. So just if you are interested in learning more, we are offering at a very, very low affordable cost a 3 weeks option session, where every Sunday morning 10 to 1, followed by question and answers, like 4 hours. Every Sunday morning, there will be this 3 week session where we'll be discussing options basics, like some of the things that we discussed here at a very high level, but we'll deep dive into delta, gamma, and what is in the money, profit of probability, what does rollover means and roll up means, and then what are the common mistakes, and then different types of spreads like vertical, diagonal, calendar, straddle, strangle, butterfly, low volatility strategies, high volatility strategies, all these things. The reason is this is how options should be played. Okay, options, what happens is 95% of the times they are meant to go to zero. The value of option meant to go to zero. So you should be in the shoes of the big players who are not in buying options, right? They have millions of stocks and they start selling options, and they collect premium and generate additional revenue. So we need to sit in their shoes and we need to kind of increase the probability of us making money. That is a way to long some sustainment of the options. Okay, and advanced strategies includes iron condors, butterflies, risk reversals, and leaps, and hedging with the stocks. How to hedge the stocks at no cost, right? Using options, how to buy insurance at no cost. So there are so many strategies that can be done with options, and that is the right way of playing options, not just buying calls and puts. So spending around 3 weeks of time, 12 hours, if you can understand these concepts or at least some of those, and you can consistently generate more income with less money and less risk. So that is the main intent of it. So with that, hope that was helpful and hope you took out some useful information out of this. Kishore, back to you.
Yeah, thank you, Uday, for explaining uh, the advantages with selling puts, where the probability is more, the risk is less. So we have a batch starting from September 12th. Again, as you all understand, options, it is like a Java, right? It is like an ocean. You cannot understand everything within an hour. So yeah, if you want to learn from end to end, starting from the basics to all the advanced strategies, you can, I shared the link there. You can register where you can learn. And also, if you want to be part of the alerts channel where they got over 90% of success rate since last 5+ months with all these spreads. And so again, you want to generate that consistent income using these strategies, you can also be uh, uh, part of the alerts channel, and you can create that income. So these are like low risk strategies where you can create income. If we want to take high risk, if you have time to do scalping, day trading, then there is more money there, but we should have the time, right? If you are busy in meetings and other things, you may not be able to enter at right time, exit at right time. But these strategies where you don't need to be that much time sensitive, right? Even, yeah, for example, they give something at 12 o'clock in your lunchtime, around 2 o'clock also you can enter, or 3 o'clock at like that, right? These are not time sensitive, which will just move within seconds or minutes. Yeah,
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 I agree. I mean, these are lazy ways of making money. You just put on the trade. You don't need to be sitting in the system, and the probability of it breaching those levels is very, very low. And even if it breaches, still you're okay to buy the stock, right? So you're getting at a better price. So put on this trade 45 days to 30 days in advance and let the premium be collected slowly into your pocket, right? So these are lazy trades. These don't need active participation. And especially when you understand other strategies, um, once you know the direction that you want to play and the implied volatility at what level it is, you can combine like in music, right? You can combine different strategies, and we will go through in depth each and every strategy when to do it, and that will help you manage your stocks, risk on the stocks, hedge them, and also generate some consistent income.
yeah. Thanks, Uday. I know it's 9 o'clock. Uh, so yeah, again, in case if you have any questions, you can send me an email or send me a message on the bot. And yeah, Yeah, next week is going to be another, it seems, week of short squeezes. So let's all make some good money with both stocks and options. Have a great week, everyone, and thank you again for joining.
Thank you everyone for your time on this weekend. Thanks.